Welcome to a webinar on the new insurance contract standard IFRS 17. This webinar is part of a series of materials that the International Accounting Standards Board, IASB, will be producing to support the implementation of the new standard. My name is Maria Karamanu and I'm a technical associate on the insurance project.
My name is Joanna Yeo. I'm a senior technical manager also on the insurance project.
Before we start, as usual, the views expressed in this presentation are those of our own and not those of IASB or the IFRS Foundation. A copy of the slides used in this presentation is available for download from the website. Those slides are accompanied by additional material. This webinar is the second part of the core requirements webinar. The first part discussed how the fulfillment cash flows and the contractual service margin, often referred to as CSM, are initially measured and is available on our website. Today's webinar will focus on the subsequent measurement of the fulfillment cash flows and the contractual service margin. Now let's discuss the subsequent measurement of these two components. A quick reminder, what are the core measurement requirements of IFRS 17? Insurance contracts are measured as the sum of two components, the fulfillment cash flows and CSM. The first component, the fulfillment cash flows, are the net future cash flow estimates. Fulfillment cash flows reflect financial risk. The probability-weighted cash flows are brought into present value terms. Fulfillment cash flows also reflect non-financial risk because a premium for non-financial risk, called the risk adjustment, is added on top of the present value probability-weighted cash flows. The second component, the contractual service margin, CSM, represents the unearned profit from providing services promised in the contracts.
In part 1 of the Essentials Measurements Requirements webinar, we discussed how the present value of the future cash flows and the risk adjustment are measured using current assumptions at the date of initial recognition. Subsequently, the present value of future cash flows and the risk adjustment are also measured using current assumptions at the reporting date. Accordingly, the material covered in part 1 on the webinar on measurement at initial recognition is also relevant for the subsequent measurement for these two pieces. For the contractual service margin, at the date of initial recognition, part 1 of the webinar discussed how the contractual service margin is determined as the amount that results in no gain recognized in profit and loss. After initial recognition, the contractual service margin is updated by reflecting the time value of money, by adjusting the contractual service margin for changes relating to future service, and then by allocating an amount earned for services provided and recognizing it in profit and loss. The rest of today's webinar will focus on the subsequent measurement of the CSM, starting first with a high-level overview of how changes in the fulfillment cash flows and the contractual service margin show up in profit and loss. Firstly, we can see that the changes in cash flows and in the risk adjustment that relate to current and past service and the allocation of the contractual service margin for services provided in the period are reported as the insurance service result. We also have returns from financial assets or any other assets that will be reported as investment income. Their accounting is covered by other IFRS standards. The effect of the time value of money and changes in financial risk for the insurance contract are reported as insurance finance income or expenses. There are a few things to note. Firstly, regarding the changes in cash flows and changes in the risk adjustment that relate to future services, those changes adjust the contractual service margin in the period those changes occur, so long as it does not decrease the contractual service margin beyond zero. Consequently, those changes relating to future service are not recognized in profit or loss. Regarding the insurance finance income, there is also an option to disaggregate the changes in the effect of the time value of money and financial risk between profit and loss and other comprehensive income. The next few slides outline the subsequent measurement of the contractual service margin in more detail. Firstly, interest is accreted on the opening balance of the contractual service margin. Secondly, as discussed before, the contractual service margin is then adjusted for changes in cash flows and changes in the risk adjustment that relate to future services. Those changes can reduce or increase the balance of the CSM. However, the CSM can never be below zero. The balance of the contractual service margin, or the CSM, is then allocated and recognized as the insurance service provided in the period is in profit or loss. We will discuss this in more details in the next slide. As discussed before, interest is accreted on the opening balance of the contractual service margin. This is done using the discount rate at inception. That is, the rate at inception applicable to the nominal cash flows that do not vary based on returns of underlying items. The contractual service margin is then adjusted by changes relating to future services. These are, in more detail, firstly, changes in the present value of cash flows relating to future service determined using discount rate at inception, applicable to those fulfillment cash flows. And secondly, changes in the risk adjustment, also relating to future service. Finally, the balance of the contractual service margin is then allocated to recognize the insurance services provided in the period in profit and loss. This allocation is based on coverage units, which reflects the quantity of benefits provided and the expected coverage period. The last slide discussed the adjustments to the contractual service margin. This slide discusses where those corresponding adjustments are now recognized. Firstly, the equation of interest is also recognized in profit and loss as insurance finance, income, or expenses. Secondly, the change that relates to future services is also a change to the fulfillment cash flows and therefore is not recognized in profit and loss. The allocation of the contractual service margin reduces the contractual service margin and is recognized in profit and loss as part of the insurance service result. Maria, could you please walk us through some examples to illustrate this?
Thank you, Joe. Let's consider two simple examples that illustrate the subsequent measurement of the contractual service margin of CSM. After 1 year, the insurer revises the expected risk-adjusted discounted cash outflows, and the change relates to future service. Both examples illustrate the adjustment of the CSM for changes in future service. The difference between the two examples is whether the changes in future service set the CSM to zero or not. The first example illustrates changes that do not set the CSM to zero, whereas the second one does set the CSM to zero. Starting with the first example, the contractual service margin at the beginning of the first year is 400. Expected cash outflows are revised to increase by 300 at the end of the year. Because of the increased expected cash outflows, the CSM is subsequently reduced by 300 because those changes relate to future service. So the revised closing balance of the CSM in this simple example is 400 minus 300 equals 100. The insurer recognizes the revised CSM of 100 over the coverage period. Moving to the second example, as explained before, this example illustrates what occurs when changes in future service reduce the CSM to zero. As you can see on the slide, the CSM at the beginning of the first year is 400. At the end of the year, expected cash outflows are expected to increase by 700. Those changes exceed the opening balance of CSM by 300 and are accounted as follows. 400 out of 700 eliminate the CSM of 400, so the closing CSM in the second example is set to zero. 300 out of 700 result in a recognition of a loss of 300 in profit or loss in the same period. The earlier slides discuss the subsequent measurement of the CSM, which will occur for a group of profitable contracts. The rest of the slides will discuss the measurement of the loss component, which occurs for a group of onerous, loss-making contracts. On slide 12, we repeat a simple example which was also discussed in part 2 of this webinar. Consider a group of contracts with a risk adjustment of 750, present value of future cash outflows of 4,250, and premiums of 3,500. Day 1 loss of 1,500 is recognized in profit or loss. There is no CSM because in this instance the contracts are onerous and the limit on the CSM is 0. The fulfillment cash flows are 5,000 and so is the total liability for remaining coverage, and comprises this liability of a non-loss component of 3,500 and a loss component of 1,500. Remember, the liability for remaining coverage represents the obligation to investigate and pay valid claims for insured events that have not occurred yet, but are expected to occur during the coverage period. So, Joe, what adjusts the loss component?
That's a good question. The next few slides discuss how do we further account for this loss component. So firstly, the loss component for the liability for remaining coverage is adjusted for any increases or decreases in estimates relating to future services. These estimates are made of firstly, the revised amounts or timings of the cash flow relating to future services determined using the discount rate applicable for those cash flows at initial recognition. Secondly, changes in the risk adjustment relating to future services. All other subsequent changes in estimates in the fulfillment cash flows are then allocated systematically between the two components of the liability of remaining coverage, that is, the loss component and the non-loss component. Now, another term for the non-loss component is the liability for remaining coverage excluding the loss component. The adjustments we discussed in the earlier slide must result in the loss component equaling 0 by the end of the coverage period. If there are decreases in estimates of the fulfillment cash flows relating to future coverage exceeding the loss component, they are firstly allocated to the loss component to reduce it to 0, and the excess of the decrease establishes a contractual service margin and is treated the same way as any other contractual service margin. This slide provides a high-level overview of where changes are reported in the Statement of Comprehensive Income for onerous contracts. It's a similar slide to one we discussed earlier in the webinar, but there are slight differences because we are discussing onerous contracts now. Firstly, changes in cash flows and the risk adjustment that relate to future, current, and past service are reported as the insurance service result. Secondly, returns for financial assets and any other assets were reported as investment income. These are counted under other IFRSs as discussed before. Finally, the effect of the time value of money and changes in financial risk for the insurance contract are reported as insurance finance income, again as discussed before. There are a few things to note. Firstly, that changes in cash flows and the risk adjustment that relate to future service decreases the loss component to 0. Further changes establish a contractual service margin. Consequently, those changes are not recognized in profit and loss. As in the case of profitable contracts, there is an option to disaggregate the changes in the effect of the time value of money and financial risk between profit and loss and other comprehensive income.
Closing with the core components of the liability that you initially recognize and subsequently measure, that's the end of today's webinar. This webinar has covered high-level information on the essential measurement requirements for IFRS 17. In Part 1, we discussed the initial measurement of the fulfillment cash flows and the contractual service margin. In Part 2, this webinar, we discussed the subsequent measurement of the insurance liability. We hope you found them useful. As stated before, we intend to produce future webinars and other materials to support the implementation of IFRS 17. Thank you for listening to today's webinar.
Thank you, and goodbye.